Welcome back to another bootcamp video. Today, we're going to be learning about one of the most important things to understand your bias, to understand your narrative, and figure out where you're going, and that's structure. Market structure shifts and breaks of structure. Understanding where the market is, how to predict reversals, what's the trend. That's what we're going to be learning today. And it does fall under the PD array, but it also falls under narrative bias, all the above, blah, blah, blah. But market structure shifts, break of structure, MSS, BOS. You've probably seen it on TikTok, YouTube, whatever. We're going to learn it today. So let's jump into the chart here, and we're going to draw out what they both look like right in front of you. Market structure shifts is where you form a high, a low, a higher high, and a lower low. So you see there's a high here. It then forms a low, and then it trades back up higher, taking the high that it formed previously, right? Running internal range liquidity, taking out buy stops, and then trading below that low it formed previously, shifting structure. The difference in between market structure shift and a break of structure is by one thing, and I'm going to show you. This is a market structure shift, MSS. A break of structure is a high, a low, a lower high, a lower low, showing a failure swing to this high. This is a break. Well, that was a terrible B. This is a break of structure. BOS, MSS. So the two differences, and let's make it a little bit bigger for you guys so it's easy to see, is this versus that. A short run on liquidity before ripping lower versus a failure swing showing weakness before moving lower. Now, my whole trading career, I thought that market structure shifts were better than break of structures. And I was so stupid for that because I randomly just thought about it. It sounded smart. Wrong. Break of structures actually show a little bit more positive signs than market structure shifts. Now, why? Why do we say that? In a market structure shift, it rips lower and shows that it needs to rip up liquidity one more time before trading lower. Now, it could mean that it's grabbing more liquidity so it can rip lower faster, or it could mean that it's not bearish enough that it needs to grab more liquidity. A break of structure shows a weakness to a high, a failure swing, which can form SMT with the S, but that's a later topic. But a failure swing showing it's lacking the liquidity to push up, showing weakness to the market to push down. When you're in price action and you see price action ripping up higher in this power of three that we're about to form, and you're wondering how to predict when it's going to start selling off, you can use a market structure shift or a break of structure to anticipate a reversal where it goes like that, boom. Once it breaks that low, it triggers a short. Then you could push down lower. Instead of price action just doing this, it most likely will go like this or like this. And I'm going to show you in price action what I mean. But the pattern we're looking for is kind of like an M. Now, you don't want to trade it like a pattern. You want to understand what we're looking for. Market structure shifts and break of structures were the hardest thing for me to learn when I was first learning ICT concepts. But it's one of the most important things. You're not looking for a pattern. You're not looking for a pattern. You're not looking for something to look like this. What you're paying attention to is the high, a low, a higher high, a lower low, or a high, a low, a failure swing, a lower low. That's what you're looking for. Now we're going to jump into the markets here, and I'm going to show you. You can see, let's go up a time frame here. You can see price action formed a break of structure here before ripping lower. And the rip lower was very lethargic. Price action forms a high, a low, a failure swing to this high, and then it sells off, breaking that structure right there. Okay? Now, this failure swing showed weakness to take highs again. And then when it started melting lower and breaking this low, look closer. What do we have here? A high, a low, a higher high, and then it breaks the low. So inside of this higher time frame break of structure, we also have a market structure shift on the lower time frame. Does that not remind you of something? How price action is fractal? How you remember in my first few videos, I talk about how you need to scale down, kind of like this, from your narrative to your profile to your model, blah, 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 blah. Look how we're scaling here, okay? Look how we're scaling. Oh, I just reset it. Hold on. Look at how we're scaling here. Break of structure. How do you anticipate that's going to be a break of structure? How do you anticipate when to enter into the trade? Market structure shift. Now let's get into replay mode because sometimes you got to drop down time frames. Let's go to the 5-minute. What do we see? Break of structure. High, low, failure swing, break of that low. And then what do we see in this break of structure? A fair value gap. What do we see price action do? Trade to the fair value gap and then trade lower. See how we have a big circle, a medium circle, a smaller, and then a smaller one, and then it rips lower. Bias, narrative, okay, intermediate time frame bias or narrative, lower time frame entry, rip down towards your target as long as your bias was bearish. Price action can form a bunch of fake outs too. For example, you want to look for a market structure shift to the upside or to the downside. And you're going to be like, oh, look, low, high, lower, low, higher, high, bullish market structure shift like I see. How do you spot it so easily? There's a low. That's a swing low. Remember my swing high and lows from my previous video? There's a swing high. There's a lower swing low. And then it broke the high here, forming a fair value gap. But when it traded into it, it failed. Why? Narrative. That's why I say narrative is more important than your entry, than your pattern. That's why I say your entry model is only 10 to 20% of what's important in trading. This is a clean market structure shift fair value gap. But it doesn't work because the narrative is wrong. Okay? Now, let's go into replay here, and let's go to when it does get into a better narrative. Let's go to the 1 minute. Let's see what we have. Low, high, lower low, breaks the high. What's formed there? A fair value gap. Drag that out. It touches it down here. It takes liquidity. It trades down to rebalance more liquidity. All right, there's our liquidity void. Trades into it. Rips up higher. So market structure shifts work, and they show a sign of a reversal. You see at the very low of this reversal, you see how price action went down, then up. At the very low, there was a shift in structure. But there's a shift in structure here, 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 here. No, not there. Right? Here. But Ben, how do I know which one to pick? Let's zoom out. Okay? Let's zoom out here. Probably going to have to zoom out a little bit more. This low. Sell side liquidity was taken here. See how price action took sell side? It's done trading lower. Its job is finished. We go to the 1 minute. And look how price action, as soon as it takes that low, it starts to slow down. And it gives us no displacement to the upside. Okay? You see, there's a little market structure shift there. Right here. But for me personally, that's not big enough. And if you waited for a reaction, you wouldn't have gotten a fill there. It trades a little bit lower, taking sell side liquidity one more time. Then it forms the market structure shift. Then it trades up higher. Narrative, understanding where market structure shifts should form, and then when you see one taking it is so important. We don't trade patterns. Remember, we don't trade patterns. Just because we see this pattern doesn't mean we take the trade, because it could just go like that. But if we see this, the narrative, buy side liquidity taken, market structure shift, and we see the lows down here, we're in a premium, and it trades to the fair value gap. It respects it. Now you know it's going to go lower. Not just because of this, that's confirmation, but because of the narrative. Market structure shift, trades lower. It shows a shift in structure, okay? A shift in the range, in where it's going to go. At every high and low of every position, there's a shift in structure, okay? High, low, higher high, lower low, okay? Oh, I keep accidentally hitting that, dude. High, low, failure swing, which is a break of structure, lower low, fair value gap. Boom. Here's where it's going to get a little bit complicated. When you see a shift in structure, when you see that low that's formed, this is a bearish one. When you see this, the leg that rips below the low that formed, which is this right here, you want to see it trade fast past it, ideally forming a fair value gap. Because when we shift structure, you want to see volatility. So when you see a fair value gap form coupled with it, that's confirmation that it's going to rip lower. Just like we had in that trade to begin with at the very reversal. I don't know where it is. Hold on. Right here. See the candle that broke the high of the market structure shift? Low, high, lower, low. Breaks the high. Look at that candle. See how there's no fair value gaps here? Let's clean it up. There's no fair value gaps here. There's a fair value. The first fair value gap that's presented is the one that breaks structure. And that's the fair value gap that gets touched again before moving up higher. That shows volatility in the opposite direction of what trend was. Breaking trend. So you see trend line traders, what they do is they draw and wait for price to break trend, which could also work. You see it broke trend, traded up, moved up higher. But what we look for is price to break trend in a market structure shift. Now remember, if it's a little complicated and moving fast, remember that swing high and low pattern, higher wick, lower wick, higher wick. That's your swing low. 1, 2, 3. Lower wick, higher wick, lower wick. 1, 2, 3. There's your swing high. Lower wick, higher wick, lower wick, or higher wick, lower wick, whatever one. This is a swing low still. Takes that liquidity, trapping people here, trapping sellers. Low, high, swing low, swing high, lower swing low, breaking the high that was formed previously. Fair value gap. That's what we look for. Now you understand, just by understanding a fair value gap and a market structure shift, you already understand where majority of traders are right now. Most traders just trade this setup. A fair value gap trade, a market structure shift, or a break of structure. That's TJRs, that's whatever. 2022 entry model ICT. That's what most people trade. But that's not enough. And that's where people stop, and that's why people are unprofitable. There's so much more. You need to understand so much more so you can use the narrative. Learn how to find narrative. Remember, I'm teaching you the alphabet right now. You need to learn how to find, you need to learn everything to be able to start reading sentences. This is our pattern that we look for, okay? This is our pattern that we look for. I'm going to show a screenshot of this right here. This is what we look for. Okay? This is what we look for. Let's just keep it red. Low, high, lower low, higher high. Breaks the high. Draw it out. There's your M. Remember? Remember that M? That's a bullish one. Remember the bearish one I showed you? Remember that at the beginning of the video? Just flip it. That's the market structure shift. Is that not what we have right there? Now, I'm going to show you an example of a break of structure where it doesn't take the low. Okay? Watch. Watch. Okay? Let's find a clean one here. I know there's one here, but I want to find one that's easier. High, low, fair swing, lower, low. Break structure. Okay. High, low, failure swing to the high, breaks the low, forms a fair value gap. I'm going to now draw it out. I'm going to take a screenshot first so it's easier to see. I'm going to draw it. Boom, 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 boom. There's your break of structure. Now, it doesn't look as clean as what I was drawing because sometimes it goes like this. Sometimes it goes like this. Sometimes it goes like this. You know what I mean? But it's that pattern of that failure swing right there. What does this candle do? Trades into a fair value gap. Now, what's interesting about this is the fact that there was a market structure shift and a break of structure above also makes it into a mitigation block, which is another PD I will explain to you. I'll briefly explain it now, but in another video, where price action, when it already breaks structure and it trades back into its fair value gap, then trades lower, this little 3 candlestick pattern up, could be 2 candlesticks, could be 4, that price move up is a mitigation block where price action could re-reference to and then trade lower again. Just like it did here. It trades up, then lower again, and then it re-reference backs to it, then trades lower again, re-reference backs to it, trades lower again. That's factoring from a market structure shift or break structure. So it goes like this, back up, down, and every up is what we call a mitigation block. It's mitigating, and it routes from that break of structure or market structure shift. So I want you guys to go into the charts and remember, it doesn't need to be clean. This is a market structure or a break of structure. Even though it looks like consolidation, high, low, failure swing, lower, low, fair value gap. Look at price trades into it twice, respects it, trades lower. Study this. Study these. I need to zoom out because it's making it like look very ugly. Hold on. Study these patterns. Okay. Study these. Market structure market structure shift, break of structure, break of structure. Baker structures are the same thing, except instead of taking the high, it forms a failure swing showing weakness. Instead of taking the low, it shows a failure swing showing strength. Market structure shifts take an extra leg of liquidity and then rip lower. You can anticipate sometimes that break of structures could come with re-mitigation blocks back to this mitigation block to then trade lower again. But that's market structure shifts for you guys. That is a foundation of an entry. A market structure shift and a fair value gap is an entry model in its own, but we need to factor in the higher time frame. But that's an entry model. Market structure shift, fair value gap. You already know an entry model. If you guys enjoyed this video, it's found it insightful, I'm glad, and I hope you guys actually understood what I'm saying. If you don't, you can book a one-on-one call with me, or you can ask me in chat or in my Discord. But other than that, guys, thank you guys for watching. I'll see you guys in the next YouTube video. Take care. God bless and peace.